Okay, welcome everyone. Welcome back. We're going to begin our wind energy panel. It is my pleasure to introduce this panel. We have with us Fred Robinson, the CEO of BayWa.RE North America, Marty Singthavanarong, Senior Vice President and Head of International Business at Gulf Energy, and Clint Plummer, the CEO of Rise Light and Power. Our moderator for this session is Jeff Hoffner, partner at O'Melveny.
Welcome, everyone. I think Sean took care of most of my introductions of these great gentlemen, so I think maybe we'll just jump right in and go from there and ask each of you if you wouldn't mind giving us a brief introduction of yourself, how you've gotten here if you want, and what you and your company does in the wind energy space or the broader energy sector at large. Fred, you're immediately to my right, so I'll start with you.
Sure. Can folks hear me? Thank you for having me. So as Sean said, I'm the CEO of BayWa North America. We do solar, wind, storage development, part of BayWa.RE, which is a global developer. We operate about 20 gigawatts globally. How did I get here? Well, that's a very interesting question. So I kind of fell into it. I actually started out in oil and gas, which I think is a little bit unique for maybe some energy folks, at least in the renewable space. I went to business school, and North Carolina had this program which is called PURPA, which is very bespoke, and I'm more than happy to talk about it for hours, but I feel like it's meaningless information nowadays, and North Carolina was taking off, and I had the opportunity to go work for a solar company and got integrated really at the ground floor at the moment where that market was really taking it off. And for folks who don't know, that market ended up becoming like the largest solar market in the country for a short period of time. And then I ended up taking a job at NextEra Energy. I did M&A there. I worked on their launch of their YieldCo. So got a lot of exposure to kind of how the public markets was starting to look at renewables at that point, and looked at a lot of different things, and can talk about that. Got a ton of exposure to wind. I think, today even I would put NextEra probably at the top of wind development. They are kind of the cream of the crop when it comes to that space in that development. And then at some point, I got a crazy idea to start a solar company with some guys out here in LA. That company was called Cypress Creek Renewables. Grew that to be the largest developer of solar energy in the country at one point, and then ended up taking a job here at BayWa.RE, where I now oversee a lot of our development in the US and mostly Mexico. So excited to be here and excited to talk to you guys.
Excellent. Clint?
Thanks, Jeff. Well, thank you, everybody, for being here today. My name's Clint Plummer. I'm CEO of Rise Light and Power, which is a portfolio company of LS Power. Let me start also by thanking Sean and by thanking Karen for being such great hosts to us here today. Our company simultaneously manages the largest fossil fire generating facility in New York City. We produce about 20% of all the electric power capacity for the city of New York. In addition to that, we're making significant investments in the clean energy transition that New York State and New York City are trying to achieve. And we're doing that with major clean energy projects, including offshore wind. I've been in the job for about 5 years. Before this, I spent 13 years in the offshore wind business. I was part of the founding team at Deepwater Wind, where we developed and built the first offshore wind farm in the entire country. So it's been a long, strange ride, and I'm very excited to be here with you all today. Thank you.
Last but not least, Marty.
Good morning, everybody. Marty from Gulf Energy Development in Thailand. So how I started at Gulf was, I'm not from the energy industry at all, so don't think that I'm the smartest guy around here. Thank you. I guess 9 years ago, they needed somebody like this in the CEO office, and thank God that they still do. And that's why I'm here, direct from Bangkok. But yeah, we are an energy developer. We are a Thai company in the Thai Stock Exchange now, and we started with gas to power, and we've expanded into renewable energy. So we have some wind, some solar, still have a gas project in a partnership with J-Power USA in Illinois. So it's in Elwood, called Jackson Plant. And we have projects in Europe, in Germany. We're building a new one, offshore wind off Lincolnshire in the UK. It's a 1,500 megawatt offshore wind farm with Corio and Total as our partners. And in Thailand, we have renewable energy we're building. So it's solar with storage, and also some onshore wind. Vietnam, we have some nearshore wind, and then in Laos, we have 3.3 gigawatts of hydro selling power back to Thailand. So we continue to look for more opportunities to find partnerships across the globe, and we'll tell you more about it as the day goes on. Thank you.
Excellent. With that, why don't we dive into some of the questions for the panel? I think first on our list are, what are the major headwinds and tailwinds you see in the wind industry, and how do you see them impacting your business in the relative short term, say 2 to 3 years? Marty, why don't we start on the other end, and we'll come down this time.
Sure. Well, for us, we operate with a partnership model. A lot of our businesses are M&As, and with the last couple of years, we've had issues with high cost of capital. So we have not been able to build too many partnerships across the globe. Hopefully, interest rates will go down in the next year or so, and then we can look into more projects we target in Europe and the UK, of course, and then hopefully something in the US. Australia should also be a good place to invest. They just started permitting offshore wind over there, and we continue to follow that and hopefully have a project there in the next couple of years.
Clint?
Thank you. So LS Power is focused on North America, so we have a lot of opportunities here in North America. The business that I'm focused on is offshore wind. So let's start with the tailwinds first. What's good about offshore wind? Well, first of all, it's a massive resource. You can build offshore wind at a multi-hundred megawatt scale. You can do it in proximity to the densely populated coastal urban centers where it's difficult and expensive to build any other new source of energy. That's particularly important in places on the East Coast around Washington, D.C., in areas up through New Jersey, the Mid-Atlantic, and ultimately New England, because we're seeing significant amounts of demand growth for a couple of different reasons in that region. We've talked a little bit about AI and data centers being a major driver of demand growth. The New York Times just a couple of weeks ago wrote a major piece on how for the first time in decades we're starting to see load growth driven by that. In other places, like in New York City where I live, we see demand growth being driven by a combination of electrification of transportation and electrification of space heating. So lots of big buildings moving away from oil and gas heat towards electric space heat. We can debate the merits of that, but that's a policy in a lot of these places. So you've got, on one hand, a lot of demand growth in places that are very difficult to bring new sources of energy into. At the same time, you've got an aging power generation fleet. In that area between Boston and Washington in particular, you have some of the oldest power generating facilities in the entire US as a function of the dense population and the difficulty of being able to build anything new there. And I know this because my company manages 2,000 megawatts of generation in New York City, 90% of which was built in the 1960s. Now, it's very well maintained. We put $200 million of capital improvements into it over the last 6 years, and it's got one of the best safety and performance ratings in the entire industry. But nevertheless, we're still talking about a very significant portion of the electric power generation that's in these vital parts of the country coming from very old infrastructure. We're going to have to continue to invest in that, but we're also going to need to build new forms of energy, clean and otherwise. And offshore wind, for those particular parts of the country where it's difficult and expensive to bring any other new forms of energy into, offshore wind can be an important part of that solution. It's not the silver bullet, it's not going to solve everything, but it's the one very large-scale form of clean energy that we can build today with existing technology and with the existing regulatory framework. What are the headwinds? Well, to quote the poet laureate Mike Tyson, everybody's got a plan until you get punched in the face. And the offshore wind industry, if anybody's been following it, has been punched in the face by really 3 global factors over the last couple of years. One Marty made reference to, which is the significant increase in interest rates. So the cost of capital ends up being one of the largest overall costs in these projects. These projects take a period of 4 to 5 years between your final investment decision and your commercial operations date. And as a result of that extremely long period of time, you rack up just a lot of interest during construction. And that's maybe not intuitive, but the extent to which you've got very significant increases in the cost of borrowing makes the ultimate cost of electricity from these projects a lot more expensive. The second major hurdle over the last couple of years has been the supply chain, and particularly the major component manufacturers, the wind turbine suppliers. For offshore, there's really only 3 that we can buy from in the US. And then similarly, for these large gigascale projects, you're talking about high voltage direct current or HVDC transmission, and that supply chain is even more constrained and challenged than the offshore wind turbines. And then the final piece of it is just logistics. You got to put all this stuff in the water, and to do that, you need boats. And in the US, we have something called the Jones Act, which requires any boat that goes from port to port in the US to be built in the US. And as soon as you put a foundation in the water offshore, that becomes a port. So we have some interesting logistical challenge around that. Ultimately, long term, we think offshore wind is a business we should all be bullish about because of its unique ability to deliver power into these difficult to serve places. Offshore wind is never going to be as cost effective as planting solar farms or even onshore, and especially not as other forms of conventional generation in other parts of the country. But if you go to densely populated urban areas on the coasts where it's difficult to build anything else new, we think offshore wind is a vital part of that, and that's why we're investing in it.
Fred, I'll turn it to you.
I don't have too much to add there. I think, maybe 2 comments I would say is this is the best demand story I've ever seen. I've been in energy for probably since I got out of college. Like the demand growth you see in electricity, it's phenomenal. And I don't think people fully appreciate it. Like if you can get a project through the queue, you can find a buyer for power. It's not a problem. I think the challenge is getting the project there. So permitting challenges, things like that. Maybe the one thing I would add there is public acceptance. I mean, we're infrastructure developers. The impact, that's what we do. We make an impact. So I think that's going to be a continued challenge where you're trying to have meaningful conversations with people and educate them about the demand story, what's happening on the energy side of the equation, and that we actually need to build this infrastructure as fast as we can, whether it's transmission, whether it's more generation. So I think that's going to be a continued challenge because these projects are going to be more and more visible, particularly when you look at wind projects, whether they're offshore or onshore, they're visible projects, and community acceptance is going to be a huge piece of that. That adds to the timelines. I think it's pretty realistic now to say when I started out, you could probably get a project done in 24 months. That's long gone. I'd say minimum 4 to 5 years right now, especially if you're looking at putting something in the interconnection queue. And unfortunately for the wind industry, we had PTCs roll off. And a lot of the industry pulled back. Like even the biggest wind developers in the market really stopped developing projects. So post-IRA now, that the passage of the Inflation Reduction Act, we've started to kind of go back and redevelop wind. That's going to, it's putting it on a different footing than solar and storage and other generation assets, where that asset class, I feel like is scaling back up now, and it's going to take time for that asset to develop, with probably the exception of offshore wind, where there was at least meaningful policy focused on those areas, and they were making meaningful efforts to try and get those projects developed, except that they do have their own set of challenges.
Now, I know both Marty and Clint mentioned the current high interest rates, or the recent high interest rates. How do you all think a potential decrease in interest rates would impact wind development? I assume positively, based on the comments you made. And are there any other financial factors that would influence the industry's growth? Clint, we haven't started with you, so why don't you go first on this one?
Oh, thanks for the easy one there. So look, ultimately, at the end of the day, we talked in the earlier panel about the extent to which these renewable projects in particular are very dense in raw materials, right? It takes a lot of steel to build a wind farm, whether it's onshore or offshore. It takes a lot of cement to do that. It also takes a lot of money. And so the extent to which there's a higher cost of borrowing, higher capital costs associated with that, that's simply going to increase the levelized cost of energy and the price that consumers have to pay. So yeah, of course, to the extent that we can see interest rates tick down, that's going to translate into more cost-effective financing and therefore lower costs for consumers. And ultimately, we hope that translates into greater demand, right? Lower cost, greater demand. But that's a major factor that's out there that's contributed to significant higher costs for renewables across the board. In terms of what could make things better, there's a number of things out there. We've talked a little bit so far about the Inflation Reduction Act. One of the unique new things that's come out of that is the ability to affect tax transfers for investment tax credits. And in a number of parts of the renewables business, that's not quite as important as it is in offshore wind. But in offshore wind, where we're talking about projects with 40 or potentially 50% investment tax credits on overall project cost, eligible investment tax credit costs of $5, $6, $7 billion, you're now talking about $2 or $3 or more billion worth of investment tax credits themselves. And so how you monetize that effectively and efficiently can be a major part of making offshore wind particularly more cost effective.
Fred?
Yeah, I think I might reframe the question a little bit. I just think about like the volatility of inputs. Like if you just kind of come through the other side on infrastructure to development and you look at trying to build a capital stack. So what is your budget to build a project in a market? The level of volatility in those inputs from when you start to when you finish is the most I've ever seen. And so the way we kind of think about it now is I think we're very fundamentals focused. So when we talk about site selection and things like that, it is really you're focusing on the fundamentals of the place you're in. And then for our perspective, I think the thing that's changed a lot is us going and locking out the inputs or the model have changed in the sense where we wait until the last second. So we try and take projects as far as we physically can before we sign PPAs, before we sign supply agreements and things like that. So I think interest rate dropping is always a positive, but to me I just kind of think about it where it's like we're saying interest rates dropping, but if you go look at the curve just came up 50 basis points. So to me, it's just more of trying to run a business that are on really, really long timelines and just the level of volatility that you're seeing now, especially when you look at the procurement side of it. I mean, it's just, we're making massive changes to the way we want to procure our equipment. At the same time, then we have tariffs on top of it. Then we have supply chain issues, longshoremen. So it's just an incredibly challenging business, and trying to sit there and model that and predict what it's going to be like 4 or 5 years has become more and more challenging as we look at trying to execute on these projects.
Marty?
Yeah, I guess. Oh, mic's on. Okay, well, I'll yell. Oh, okay. Let's yell.
Yell softly.
Okay, so for us, all the projects that we develop are very sizable projects. So it's like gigawatts up. We don't want to do any small projects because we have limited resources. And these developments for offshore wind, for example, they're highly capital intensive. And the first component that go into this project is the site acquisition, right? This is like the tenders that we have to get into, and it's getting the seabed rights, right? So if you can go back in time, in the UK, for example, when they bid for the seabed rights, these are multi-billion-dollar bids. You need to find the money to do that. So having a lower interest rate would be greatly beneficial for companies like us. And certain countries, when you try to do a bid and your credit isn't really there internationally, then they require bid bonds, right? So for one bid that we were interested in participating in, they needed 6 billion euros that we had to come up with and just leave there during the process. So that was about maybe 6-7 months of unknown, right? And we had to find it somewhere. So we were out. We were like, no, it's okay. And the partners that we found also did not have the cash. So these are things that are very important to make sure that we have the lowest interest rates as possible. Thank you.
moving on, I know we've talked about data centers or at least referenced them. What do you guys think are the most significant technological or other trends in the wind industry? Are they providing new opportunities like data centers? Are they addressing challenges with the supply chain, local opposition? Fred, why don't you start with that one?
I would go back to we're trying to look at as much stuff now. I think we try to take development much more holistically now than we probably have. So our background, BayWa started out as a cooperative, so we have a lot of relationships on the ag side. So we've tried to come at it and look at our sites more of like, what can we do to kind of do regenerative things? Can we do things more with the ecology? Like, I talk more with biologists than I ever thought I would in my life. So try to do things like that. And there's things you can do now with having flight monitoring sites on which we have these cameras set up, using AI to do more predictives around avian risk and things like that. Also, there's new technologies that are being deployed on the blade tips, so to try to eliminate noise. So, trying to get in front of those things, I think, are exciting. And at least from the wind side, things are pretty mature, but you're still to continue to see developments on the technology side, so the more competitiveness. So, when I think about where we developed, and we're mostly focused on onshore. We do offshore development, but we don't compete with these guys because of the $6 billion checks. I think you're going to have to evolve in the way that you site wind now, and it's either going to have to be closer to load or in resources that just aren't as good as they used to be, because most of the wind has proliferated at this point. Those sites are developed, and so you're looking at, as the technology develops, how can you come up with turbines that have better cut-in rates so that they can kick on at lower rates and things like that, and the level of technology that's getting applied there. We talked about AI from the demand side. I remember when I first started out doing wind development at NextEra, we had an entire company called WindLogix that was based in Minneapolis that was like 50 PhDs trying to do all these wind analytics. I have one person right now who has a piece of software, and she can run arrays in like a matter of minutes. So that's very exciting to me because it is very hard to forecast wind resource. Anyone who's been involved in the wind industry, it is one of those things where it is like you model it and it does exactly the exact opposite, and you can have entire years where you're off forecast significantly. So the continued evolution on that side and being able to predict waking, the way that the turbines interact with each other, I think that there's a lot of good stuff happening there.
I'll actually ask a follow-on because I'm personally interested in it. As the technology has increased in these things with the wind and the tips on the blades and those different types of things, are you seeing more repowering of the old projects? We drive out to Palm Springs here, and you can kind of see every generation of wind turbine from ancient.
You'll be happy to know I own one of those projects, and we are repowering it. Yeah, absolutely. It is more challenging than you think. And this is, we can talk about a lot about this. The IRS plays a big role in this because the way that you repower sites is it's subject to the tax code.
And the 80/20 rule.
Yeah, so there's a lot of limits in what you can do, but there are a lot of the monopole towers, I think, that you'll see, which for folks who don't know, there's different types of tower structures. Lattice is kind of the ones you see. It looks like a ladder you can climb up, and monopole is just a fixed pole. I think a lot of those, it's easier to repower those sites based on the foundations and being able to do that, and being able to swap out, especially if you're using the same technology. It is interesting because I think the suppliers aren't as enthusiastic as the developers about it. They want to go out and sell whole new complete equipments. Repowering isn't as lucrative, I get the impression, as it is to do a whole new site. But I think you'll start to see a lot of that. And the level of performance of those sites is going to be like phenomenal. I mean, you could guess what those sites are doing in terms of capacity factors out there in Palm Springs. I presume they're probably somewhere in the mid-teens. And those sites will probably be repowered easily into the mid-20s and maybe low 30s potentially, based on the technology. So a lot of potential there, I think you'll see. And I think that's starting to come out now. People are starting to look at it a lot in their sites and see what they can do. It is challenging because, if you're going to go repower in West Texas, that has its own unique challenges just because of the grid and the curtailment there. So I don't think that that's as much as an opportunity as it's probably being sold right now. But I do think that repowering in general, solar, storage, that is something that is completely underappreciated as the technology continues to develop. People will look at opportunities to go in and put more efficient technology there.
Clint, anything to add on technological trends in the industry?
Yeah, I think there's 4 things that are going on with technology. One is on the demand side, just creating additional load growth. Second is on technologies that can help in making it easier to develop and permit these projects. The third is on the supply chain itself, and then the fourth is on the operationalization of the projects. On the demand side, we talked a little bit about this. It's data centers, it's AI, it's the electrification of transportation, and it's the electrification of space heating that are playing out across the country. Fred talked a little bit about some of the tools that we're seeing develop on screening softwares that can help in advancing the development of projects. I think the supply chain is a really unique part of this because the IRA is creating a lot of opportunities for investment here in the U.S., particularly in our business in offshore wind. We see big incentives, an additional 10% ITC boost for domestic content. So at this point, there's no offshore wind turbines manufactured in the U.S. So there's an incentive for manufacturers to bring that capacity here to the U.S. With offshore, as with onshore, we're seeing wind turbines getting bigger. There's a lot of constraints in that supply chain currently. So our hope, our expectation is that the Inflation Reduction Act and those tax incentives will allow the supply chain to come here in the U.S. There's a number of benefits associated with that. Number one is just additional supply, it's additional capacity. But in addition to that, by having that capacity here in the U.S., it will make the technology itself a lot more cost effective.
Marty?
Well, for investors like ourselves, having repowering opportunities are great opportunities to reinvest. The IRA, as Clint mentioned, is very attractive for us because that's where we can possibly get some profit by increasing the sustainability opportunities in the U.S. So yeah, we love it.
All right. Well, moving on. I know we've talked a lot about tax credits in the industry and PTCs and ITCs. What role do government incentives and subsidies play in the wind energy industry? I mean, I know my career is pretty much based on financing tax credits. And how economically viable do you see the industry is without them? Are there any specific actions, regulatory or otherwise, that you would like to see taken? I'm sure we could spend all day talking about IRS guidance on domestic content, but that or anything else you guys would like to talk about on government incentives. Clint, how about you go first?
Yeah, I'm happy to do that. I think there's two different types of government policies on this. One is an outright incentive where we see, federal tax incentives that are just economic boosts for projects. And yeah, those help. I think what's at least in our line of business, something that's more constructive is to think about how we can use government policy to shape markets and to allow competition to drive the infrastructure that gets built. And so, the first offshore wind project in New York, which is a project that I developed, won in a head-to-head open technology solicitation against a new fossil-fired peaking facility. And in that regard, we thought it was a good example of well-shaped public policy. In that case, a state-owned utility, the Long Island Power Authority, identified a need in a particular location for a specific amount of energy. And they opened up the competition and said you can either bid a conventional gas or oil-fired peaking generator, or you can bid renewables paired with storage. We bid a offshore wind farm paired with energy storage, and in that one particular location, the Long Island Power Authority found that it was more cost-effective. Now, granted, this was 2016, so we had a lot more favorable interest rates and less supply chain constraints. But it was more cost-effective then to build an offshore wind farm, pair it with batteries, than it would have been to have built a new fossil-fired generating facility. We think that's the right type of market where it's an open competition, where the policymakers are identifying reliability needs, where they're appropriately valuing the energy, the capacity, and the environmental attributes. And in that kind of an open playing field, where the marketplace has the ability to bring lots of different types of solutions forward, we think that's the way that we affect the most responsible energy transition. We think that's a much more effective use of public policy than only throwing additional incentives or economics towards projects.
Marty?
Yeah, well, we like the incentives, for us because we're looking pretty much towards the partnerships that we can possibly participate in. When IRA was announced, we tried to understand it more because we're in Thailand. So we're lucky that we can go over to the U.S. Commercial Service office in Bangkok, and then they got us to this what was called the U.S.-Thai Energy Dialogue, where we visited with the U.S. government, with the Secretary of Energy, and we got some more clarification. We're not based here, but we want to grow here. So for investors like us, having additional incentives are the key to investing here, because again, we're talking a different currency, right? Hopefully we can do dollar-based investments, but sometimes the capital requirements are not there that meets our specifications. So yeah, more incentives, better.
Fred?
Yeah, I think to me when we talk about this, it's really I put this in discussion into two buckets, which I think are pretty distinct. One is what is climate policy, and then I think there's a conversation about energy security and onshoring. The climate policy piece of it, I believe we should have a price on carbon, so that's kind of how I think about it. I agree, like a broad markets-based approach to that, I'm supportive of. I think we've tried it a few times. It's not attractive because it gets labeled as a tax. So. I don't know. I think we should have a price on carbon. And then on the energy security side, I think that is more of a where do we want to go as a country, and how do we look at energy security, and how are we looking at trying to reshore our technologies, and how do we view that from strategic importance to us? That to me is other elements of the Inflation Reduction Act, where you're starting to have incentives behind, getting on manufacturers to onshore. I think you need to do that in order to make the technology competitive. There are countries like China that have its huge advantage of us in terms of scale, the operational capacity, and things like that. And so we have to put incentives in place in order for that technology to come back here. I do personally think that that's the right thing to do, because I think that we're going to want to have that energy security when you look at the demand story here. And if we think that being a leader in AI is of strategic importance, then I think having credible access to safe electricity is a big component to that. So that's kind of how I think about it. In terms of other regulations, I think probably the biggest one that I'm sure, I don't want to speak for the rest of the group here, but is permitting reform. I think you've seen some really good movement here in California on some of the work they've done on limiting the CEQA litigation. The bill that is being proposed right now is a bipartisan bill in the federal government. I fully support, and I think we should pass. It's disappointing to see that some climate scientists are against it. I think if you have issues with methane, there's other ways to solve that, and that we need to get a bill that's passed where we can meaningfully start to move infrastructure, because it's becoming a real problem. And I think in the midst of that too, you kind of have to think about inflation risk. Whereas you have to recognize that the reason why a lot of this technology was being built in other places because it's cheaper to do. And so if you're going to onshore it here, it's going to be more expensive. So we need to be really cognizant of that, because I think one of the things I would say is that if you took these incentives away, I actually look at my industry, I don't think it'll slow down. That's how big the demand is. Power prices will rise to meet my cost. And I actually think that a lot of us will get excited because we won't have to deal with tax equity anymore. And the debt capital markets, I think, would be very eager to come and look at securitizing our assets, because we don't use a lot of securitized loans. We use a lot of back leverage. So I think that the capital markets would evolve pretty quickly and get excited about the opportunity. And I think Microsoft signing a PPA for a nuke that has been decommissioned for a period of time and is willing to bring it back online shows you their willingness to deploy capital and incentivize new generation. So I do think that is the kind of thing where it's a very complicated topic, which I think is very difficult to kind of explain to a layman, but that there are really some serious implications. And I think we need to be very thoughtful of that as we go forward as an industry, because I would be very concerned about having rapid power price rises and things like that, and the implications. I do think that these data centers are going to get caught in these situations. Like signing a PPA with a nuke is probably going to start to create some equity issues. And those are things that I think about for our industry, and kind of how can we be proactive and communicate those sort of risks.
Now, I know you gentlemen are mainly developers of projects, but our next question is focused on what do you see as the key challenges in scaling up production of wind components, which is more on the manufacturing side, to meet global demand? And how do you see companies or the suppliers that you use addressing those supply chain constraints? Marty, do you want to take this one first?
Sure. Well, yeah, we are developers, and when we're looking at this topic, then what's key is that it's cost, right? We have to look at the bottom line. Of course, we want the best technology, right? The best quality for these components. But if it's going to cost 3 times as much to be built in the U.S., then there's no way that our EPCs are able to use it. So we have to look at countries like China to get these components from, and it's just economics, I think. And I don't know if my panelists will agree.
Fred, do you want to go?
It's funny because I actually probably will take a different perspective. I think that we've made a meaningful effort to try to onshore as much as we can. Mm-hmm. It's just a supply chain risk. I can't build. I mean, we're doing smaller projects, but my smaller projects are $300, $400 million projects. I can't order a piece of equipment and then just be like, well, maybe it'll show up. Mm-hmm. So for our perspective, we've started to lean very much on relationships and really looked and focused at trying to secure as much domestic content as possible and really push our suppliers to say, how much can you get and where can you get it from? So I think, an example like, from, and I know we're a wind panel, but on the solar side, like we don't buy any poly that doesn't come from Hemlock in Michigan. We just don't, we won't buy it. I won't order it. We won't go through the process of it because I don't want to deal with the risk of it. So I think it's when you look at the technologies like that. Steel, the wind side, I think, is actually, at least on the onshore side, is probably better positioned. There is a lot of manufacturing that was already being manufactured here, and they've made better efforts, I think, probably than the rest of the industry to get more domestic content coming forward. So I'm actually pretty bullish on that side. I think the solar side is probably a little bit behind that. Storage is actually making good progress. So, I think that we're pretty focused on trying to buy. We're still cost focused. This isn't like a big margin business we're in. But to me, I think that there is a little element if we're in a competitive process and I have someone I know that I can get domestic content from, that it's a pretty significant bias that we have when we look at our procurement. And it's really just mostly from a security perspective. And we want to help these industries get off the ground in the U.S. and we're going to have to take some risk in making that happen.
Clint, your perspective?
Yeah, from the offshore perspective in the U.S., we've got a couple of different challenges. One is on the OEMs. Let me just hit that really quickly. Today, there's about 64 gigawatts of offshore wind built around the world. About 49% of that's in China. The UK is about a quarter of that. Germany is about 15%, and the rest is scattered around Northern Europe. So you've got an industry that is very heavily concentrated in kind of 2 different parts of the world, where you've got lots of manufacturing capacity in Europe and a lot in China. The U.S. has made a decision so far that we're not going to be allowing Chinese offshore wind turbines in the U.S. So there's really 3 manufacturers in the U.S., all European, that we can buy from, and that's a major constraint. To the extent that some of those Chinese manufacturers are able to make inroads into Europe and ultimately in the U.S., we think that takes some pressure off the supply chain and ultimately off of pricing. Same thing goes for HVDC and some of the big transmission components. Not a lot of that is made in the U.S. today simply because of where the demand has been historically. Again, to the extent that we can bring some of that capacity to the U.S., it creates both more global capacity, which is needed, but it also makes it more cost effective here. The other part of it is kind of a bridge to our prior panel, which is just raw materials. So when we talk about offshore wind, we talk about these massive rolled steel foundations, massive pipes, 30 feet in diameter, 3-inch plus plate steel rolled. And there aren't mills in the U.S. that can produce a combination of the grade and the dimensions of this steel currently. And so what that means is we've got some real tariff issues to manage currently, because we can either import steel from the mills around the world that can produce the right grade and dimensions of this plate and then roll it here, in which case we're paying tariffs on it. Or we can wait for some of the big steel manufacturers to perfect their capacity to build that. Nucor as one is working on that currently, or we can import the rolled fabricated foundations from elsewhere. And if we're importing a product, we don't pay that tariff. So it's a bit of a challenge in the way the tariff structure is constructed today. It's one that we think creates an incentive for producers like Nucor to be building that capacity here in the U.S., but it's a major challenge.
Turning to our next topic, we've talked a lot about the Inflation Reduction Act and its, possibility for additional tax credits for domestic content. Has that policy and the possibility for domestic content adders affected your equipment supply decisions, or are those decisions to get that credit, or are those decisions mainly based on security of supply chain and other things, and the credit is simply a bonus that you'll happily take? Clint.
Yeah, I mean, it's something that in the offshore wind business, no projects have been financed yet since the IRA has been passed. So, number one, there's not a clear pathway to be able to establish that. To make the IRA's domestic content adder work in the U.S., you have to have a combination of U.S.-made steel plus a certain percentage of your manufactured components. And absent having wind turbine production in the U.S., it's very difficult to see how you'd be able to get to that. So at this point, we're not assuming that any of the current projects are able to be eligible for the domestic content adder. We're very hopeful that as the industry matures and as manufacturers are willing to bring that capacity here to the U.S., that will stimulate demand, but we haven't seen it so far, and therefore it's not affecting how we're thinking about buying our components.
Fred, you addressed this briefly, but
Yeah, I think we certainly consider it. I would say pretty similarly, we're not generally underwriting it in deals now. So we're kind of looking at, hey, we'll go make supply decisions. Can we get domestic content? The steel piece is certainly a big question, being able to access as much of that. Although I think that side of the equation has evolved much faster than I thought it would, and it's actually looking pretty good on getting access to steel. But it's one of those things where I would say it's a consideration. There's certainly a cost component to it. So, it's not like I'm going to go build a project for $300 million and the domestic content project's going to cost $300 million. You're going to eat into that domestic content adder to some extent. So it's a little bit of analysis you have to do to make sure that it's still accretive to a project to make that level of investment. The other piece maybe I would say is it has pretty strict labor requirements. That's much easier to do in some markets than others. Particularly markets where they don't have, prevailing wage and things like that, and then the apprenticeship that goes with it. That we're finding requires a lot of effort, and with tax equity investors they're very strict on how you document all that stuff. So the level of effort that actually goes into that process is, I would say it's still, in our analysis, looks attractive to do that. And we're actually working on our first domestic content project right now. It's just not something that I think I'm really comfortable to put into our projects going forward, saying, okay, all our projects are going to be domestic content, and let's really start underwriting deals from the day we start at a ground lease. It's something more we look at much later stage in the project as we're kind of really locking in supply chain pricing.
It's interesting you say that. Tax equity is very intense on the domestic content adder, and we have a lot of tax lawyers who sit in New York City who are looking at things like torque tubes, the heat pours for like steel that's ported into rings that go into the foundation. It's a very detailed process. Marty, I know you're international and the IRA probably doesn't touch your business as much. Anything you'd like to add on this question?
We haven't looked at too many projects that qualify with those requirements, so apologies.
No worries at all. I wanted to give you the opportunity. I think we had one more question on our list, and I'll kind of flush that together with some concluding remarks, if you want to offer any, and then we'll turn to the audience for questions here the last, around 10 minutes to go. Looking ahead, what opportunities and challenges do you see for wind energy in general moving forward? Marty, we kind of skipped you in the last one, so I'll go to you first for this one.
Sure. I think that for us, one of the major components that we've been following the development of and trying to see if there's any new development in it is the battery, right? Because now we're going to create so much energy, and the wind farms are getting bigger in size, solar farms are getting bigger in size. So now we're hooking up batteries to it. But who has the best battery? in the world. I think the top 5 now should be Chinese companies. So hopefully American companies will be able to compete in all this. Right? I know that a lot of startups are starting to grow, and I'm looking forward to seeing as much as participation from U.S. companies as possible, because there's so much land here to build all these new wind farms and solar farms. We have to hook up U.S. batteries. So we don't have to import anything, right? There are many resources here to do it, I think, and we're looking forward to that.
Clint?
I think my view on offshore wind is that it's been a bit of a boom and a bust cycle recently. I think that here in the U.S., there are places where offshore wind makes a lot of sense, and then there's places where it just doesn't, right? So there was a point in time where, every state that had water was thinking about developing offshore wind. Like, offshore wind makes sense when there's a certain business case associated with it, and that's where you've got a densely populated area where it's difficult and expensive to build anything else. It makes no sense to build offshore wind in the Great Lakes. It makes no sense to build offshore wind in the Pacific Northwest. In both of those places, you've got access to lots and lots of other forms of cost-effective, low-carbon, and other forms of energy. But if you come to places like Southern California, or you come to places like the Boston to Washington corridor, it's densely populated. It's really difficult to get any other new form of energy into these areas. And so our view on this is that the offshore wind industry is going through a rationalization process, that you'll likely see a steadier, albeit slower and smaller scale of projects moving forward that are more focused on serving fundamental needs in places that need the power and that don't have other more cost-effective ways to get the energy capacity and renewable attributes. But where it doesn't make sense is in places that have other options, and we should be really focused on trying to develop these projects in places that have fundamental needs.
Fred?
Yeah, I think, we talked a lot about it, but the opportunity side to me is, like I said, if you can get a project through the queue, like there's a lot of ample opportunity right now. So I think the opportunities really right now are pretty limitless. I do think that the evolution of kind of how we think about projects is interesting to me. You're seeing a lot more solar and wind hybrids, solar plus storage, wind plus storage, things like that, and looking at ways that you can come up with a more comprehensive product offering. Challenges to me is just trying to limit the volatility. I do, it's like, permitting, you have interconnection issues, you've got supply chain issues, interest rates. So I think, from our perspective, when we look at trying to develop right now, you just heave out of a lot of unpredictability into the development cycle. And so trying to limit those and find areas where there is more predictability. So, interconnection, whether it's utilities or ISO RTOs that are providing better guidance, more clarity on how they're thinking about interconnection queue, how they're thinking about price formation. That's something that I think is pretty interesting when you see more of these renewables increasing the grid. How are they looking at ancillaries? Because I think we want to be solutions oriented. So I think to me, it's just more about partnering with a lot of these folks and get better understanding of how they're seeing things, and that we can develop a longer term vision together. Same with the supply chain too. It's, it's understanding what does it look like to onshore this equipment? How committed are we as an industry and as a country to onshore this equipment? And trying to bring that all together. So I think, from my perspective, it's just trying to limit a lot of the volatility right now I see, at least through the development cycle, to try to make our business more predictable, because that's when it becomes more cost efficient. The industry starts to align, we develop better processes, and then we start to scale. And, for infrastructure, that is the biggest piece of that. That's why we talk about projects getting bigger and things like that. If I'm going to spend $5 to $10 million to develop a site, especially if it's going to take me 5 years and I'm going to be paying capitalized interest on that, like, I want to develop the biggest site possible. So I'm going to put as much wind on that site as possible, as much solar, as much storage. And I think you're starting to see the industry do that, knowing that these queue positions have become so valuable that you're literally trying to do everything you can. It seems to me like FERC has started to understood that, that there's a lot of value in these queue positions and that they're not being fully utilized. And so I'm hopeful that a lot of the grid operators will start to see that as well. Like California with a surplus interconnection, being able to add batteries. We have a wind project right now where we're going through the process of adding a battery to it. It's a relatively seamless process, but CAISO understands the fact that that there is ample space on that queue position, and as long as we don't exceed the capacity of the wind project, that it's fine for us to add a battery. We have to go through a simple charging study, but after that, it's pretty straightforward. So I think about things like that, where we're just kind of being a little bit more pragmatic about how we approach this thing, because I think the demand side is there, and so you're going to see constant signals coming from the demand side for us to bring more generation, to bring more capacity to the market. So it's about bringing all these stakeholders together and say, hey, this is a very real thing. There's very real issues we need to solve, and we need to work together to come up with solutions.
Well, thank you, gentlemen. I think we wanted to save the last 10 minutes for questions from the audience. I think there are microphones, I'm told, around here somewhere if anyone has any questions for our panelists. There's one over here if someone... Mike's right behind you.
Hello, thanks for being here today. My name is Calvin, I'm a first year MBA. So you've spoken a lot about capital costs and interest rates, and interest rates is a choppy environment. So could you talk to different alternative sources of funding that you guys are also looking into as well? Thank you.
Anyone want to go first?
Well, for us, it's we look at all forms of flexible financing, right? Right now, we need to have double-digit returns, so that's the challenge. Where do we get the financing to meet those returns? So we're flexible.
I think when you talk about offshore wind in particular, you're talking about projects that have to form multiple billions of dollars worth of capital, and you've got lots of different pieces associated with that. So there's a lot of at-risk capital. In some cases, several hundreds of millions of dollars that have to be invested in these projects even before you get to a final investment decision, simply to mature the projects, to arrange all the permits and the contracts. And so all of that's got to come from equity, and that's usually the most costly source of the capital stack because it's the form that's the most risky. Once you get past the final investment decision, then you still have a lot of equity in the project, but you end up with a number of different levels in the capital structure. Usually there's some form of senior secured debt that's your most cost effective. In some cases, there'll be some mezzanine financing in there. In most of these projects, there's a tax equity bridge loan during the construction period, and then ultimately that rolls out into either a tax equity partnership or a straight sale of the tax credits themselves using a transfer model. So it's actually really interesting from a purely academic perspective in trying to engineer the capital structure around this. But these are some of the biggest infrastructure projects anywhere in the world. And as a result, there's a lot of financial engineering that goes into ensuring that you have the most cost-effective capital structure.
Yeah, I would say my probably biggest concerns when rates came up was whether or not the capital would really pull back on the sidelines. And there certainly was rebalancing a lot of the renewable portfolios because the real estate investments weren't doing too well. But I think I've been very encouraged with the level of capital still sitting on the sidelines waiting to deploy, whether it's equity capital, debt capital, tax equity investors. The capital side of this equation is still very, very active. Costs have risen. That's pretty natural. And I think that they maybe have rebalanced a little bit. There was some more enthusiastic infra investors who wanted to take development risk. I think they're much less likely to do that nowadays, mostly because yields have risen on the operating side, so that they really don't have to take that risk to hit their returns. But it just really depends on your business model. What are you trying to achieve when you're developing? Do you want to own the assets? Do you want to flip out of them? I think that there is more than enough solutions there. You're seeing a lot of capital recycling happening right now. I think that's just largely because you look at a lot of these companies have huge investments coming up, and they're trying to recycle out of some projects that they've had and redeploy it. But maybe the M&A market has slowed a little bit, but I think if you have a good portfolio and good assets, there is still a pretty active capital markets right now if you're trying to go out and raise any financing.
Other questions from the audience? Did you?
Thank you all for being here today. So many of you had mentioned that we're in an era of unprecedented load growth. We have electrification, data center, AI data centers, and manufacturing, onshoring. So energy resources are becoming increasingly scarce. But thankfully, it seems that industry players are willing to deploy capital. So my question is, how do you see these deployment decisions being made? Would it be co-location with wind assets? Would it be wind, solar, battery energy storage, or maybe even gas?
I think that from a data center perspective, and then separately from electric vehicles and thermal energy as being kind of the two big drivers of growth. I think the initial growth in data centers has largely been driven by the latency, the ability to connect to the bulk fiber optic networks, and to be able to very quickly process data. So that's more been based on proximity to large available areas of land and fiber. So that's why you've seen a large growth in that in the areas around Northern Virginia. That's starting to change now that we're approaching kind of hyperscale data centers, but that was the original kind of thrust with that. And then separately on the other major drivers of load growth, the electrification of transportation and space heating, those things tend to be more concentrated in areas of more dense population. So I think there's going to be some co-location, but I don't think co-location is a silver bullet. We talked a little bit about the reactivation of 3 Mile Island and the ability to co-locate data centers next to that or potentially other power plants. And there's some good opportunities, some good projects that should get done there. But at the end of the day, this business is about land. And it's really difficult to put together that much land in one place that can accommodate both power generation and a hyperscale data center. And so I think you're going to end up with some very unique co-located opportunities, but I think those would be more the exception than the rule.
Yeah, I actually completely agree. I think it's going to be all the above. There's so much demand there that it's all the generation is going to have an opportunity. I think that there are data centers out there developing right now with gas gensets behind them. They're doing it very quietly, but they're doing it. And co-location, I think it's just they're trying to go as fast as they can. So the easiest thing to do right now is to go in and say, okay, well, you have a 400 megawatt site that you're developing. I can go co-locate into a 400 megawatt data center. So that's just speed right now. And I think that as they start to evolve their business model, they'll be a lot more selective in sites. And I think that they'll start to move away from fiber. They can actually lay something that's called dark fiber and build a bunch of repeaters, and it'll make much more sense for them to go out towards the generation where it's much easier to build out, and you have a lot of congestion issues and things like that. So I think you'll see a lot of evolution. But I would say I realistically do not. I think a lot of people are saying it feels a lot like a bubble. I would probably be on the other side of that, saying that I think it is pretty real. I think that I was reading just the other day that I think the top 5 players have $500 billion in cash on hand. So, and they are more than happy to spend it. They are spending it, and I do feel like from their perspective, it is a winner-takes-all race. So this isn't something where like you're going to have 4 or 5 AI models that are kind of like the top echelon. I think that they think it's going to be 1 or 2 that's really going to control the market, and that's how they're approaching it. So I think that they're very over-enthusiastic talking to them, what can be done on the infrastructure side, but I think that there is enough money that they have available and cash on hand that they're going to get utilities to move. You know, you already see cooperatives and some of the smaller utility players starting to cater to these guys and start to develop around them. And there's a lot of ways that they have a lot more control over their grid that they can make those sort of things happen. So I do think that this demand story is not going away. And then I think once you just layer on how you look at AI in terms of your daily use and things like that, that to me is more of the electrification story that he was talking about, where it's going to be such an integral part of your life that you're going to want to have every piece of software tied into everything. It's like you see crazy things now where like, I don't know, I can connect to my refrigerator. I don't know why I would ever want to do that, but I can do that. So things like that, I just kind of think it's I think that a lot of the numbers you're seeing out there are pretty crazy, but I think that there is some fundamentals based into that you're really going to start to see some of these guys put on sites that are going to be pretty epic in size.
Marty, anything to add?
Well, we just started, I think, developing hyperscale data centers in Thailand, and for us, we're finishing up our own data center that we're partnering with Singtel in Thailand. So the future, you have to stay tuned to see what's going to happen in Thailand.
I think we probably have time for one more question.
Yeah, one more quick question.
I'll ask. So that's actually a little bit of a two-part. I am curious to ask the moderator if you have any comments or anything you can tell us about maybe the way the tax equity market could have changed due to the tradability provisions in the IRA, whether that's affected your business at all. And then secondly, I wonder if any of the panelists can talk about, given the comments you just said, how much of your existing project pipeline over the last few years has been financed by, VPP agreements with those big data center players who, for years now have been trying to get their emissions down through financing renewables, even if they're not actually actively using the thing. So if you could comment on that penetration in the past, if you've seen that at all, and then I'm interested in the tradability of the tax credits, whether that's done anything to your tax equity credit business.
I'll try to answer in 30 seconds, but then I'm happy to chat after since I know we're trying to keep on time. It's done a lot of different things in our market. 2 years ago, we could write a tax equity flip deal on a napkin and pencil out the economics, and you were done. Now, if you're still talking big bang tax equity, you still have the partnership flip, but we've gone to a lot more hybrid structures where the banks are self-monetizing 50% of the credits, sometimes less, 25%, and then on-selling a large portion of the credits to corporates or others. And that's if it comes into the tax equity market at all. These big banks have a lot of clients and customers who also have large tax appetites. So they are a fairly good resource to, if they're not self-monetizing the credits themselves, identifying other companies, a lot of food and beverage companies that have tax appetites, and then selling a portion of the credits on, and that allows them to expand their balance sheet and invest in more deals, taking only a portion of the credits. And of course, you have tax credit transfer, where you have some deals where a sponsor does it directly and then directly on-sells the credits.
So we're going to wrap this up right now. Thank you so much. We'll save that question that I'm sure the panelists can speak to you after. So please join me in thanking the Wind Energy panel.